Hey friends, welcome back to the Above Board podcast. My name is John Kennedy. I am one of your hosts, and today I'm going to attempt an interesting feat, which is actually, it's not interesting. It's the opposite of interesting maybe. But I'm going to try to tackle the most boring topic in personal finance and make it unboring, which is insurance. So why am I doing this? Well, I've seen firsthand the result of bad planning or negligence. It's really tough getting a call from someone whose spouse passed away and the year before they let their insurance plan lapse because they forgot to pay it. I've also seen firsthand from families the impact of not having proper health insurance in place, and this catastrophic impact of like a major health event forced a family into bankruptcy. So we talk a lot with our clients and on this show about having a plan and the successful outcome of these retirement stories that we share. But the truth is, there are more situations out there where these bad things happen to good people, and they just didn't take the time to think about this stuff. Life gets busy. We don't want to be thinking about these morbid conversations like having proper life insurance. But I'm doing this podcast today because I think insurance is probably the most important thing that we could be doing that we're not thinking about or worrying about on a daily basis. You know, we forget to audit, like, are we in the right health insurance plan? Or, as our income is going up, so too probably should our life insurance. But are we talking about that? Are we auditing that? Are we looking at that? Are we changing our beneficiaries? I can't tell you how often I work with people where I preached this to them from meeting to meeting, like, hey, let's look at your wills. Let's like update your beneficiaries. Let's see if our insurance is right. Let's kick the tires on all this stuff. I'm like, yeah, it's fine. We'll get to it. We'll get to it. We'll get to it. And then like magically they're taking a trip to Europe in 2 weeks and they suddenly realize all this stuff to do. There's good news to that though. They say that if you wait until the last minute, it only takes a minute to do. So hopefully this podcast today is going to be your kickstart to looking at the stuff and auditing it. So what insurances are actually important? So let me first give you a disclaimer that we don't write any of these policies. This is a situation where 9 times out of 10, we refer this out to a professional who specifically does these things for our clients. But we are in a position, Matt and I are in a position, and the clients that we talk with, to understand how these things work relative to their job, to their income, to their phase in retirement or life that they're in. And we're in the driver's seat to at least be having these conversations with folks. The second disclaimer I'm going to give you though is I'm not going to preach at you. In fact, today I'm going to kind of just share with you what I have set up in my life. And so I'm going to use myself as a proxy for things to consider. This is definitely not the be all end all, but this is something that my family and I, want to ensure is up to date. And we also take time to audit this once per year to make sure that these things are still aligning with our goals. So let me start with the big topic at hand, life insurance. So when it comes to choosing life insurance, there's this debate that often centers around, should we go with term or should we go with whole life insurance? And for the most part, that kind of represents the two different types of policies one could pick, term or whole life. So term is sort of what it sounds like. It provides coverage for a specific period of time, anywhere from 10 to 30 years. And it's designed to offer protection during these times of high responsibility, like raising a children and having dependents, having to pay off a mortgage. So the key benefits to term typically is the premiums are generally much more affordable compared to whole life. They're very simplistic and straightforward. You have this term length of, let's say, 30 years for a face amount of $1 million. You set your beneficiaries and you know what you're getting. You know how much you're paying. It's really straightforward. And it is temporary coverage. So once that term comes to an end, so too does the coverage. So if you outlive the policy, there's no payout. But I'm going to explain in a minute why that's not necessarily the worst thing in the world. As we compare that to whole life, on the other hand, this provides coverage for your entire life as long as premiums are paid. So it combines death benefits with things like a savings component known as accumulating cash value. So there are advantages to whole life. It's permanent coverage. You can build cash value, as I just mentioned, that can grow over time. So you can like borrow against that or maybe withdraw those. And there's even potential for dividends that come with that. The trade-off that I find is that with whole life insurance, it comes with much higher premiums compared to term. And it's also a much more complicated product, but it can serve you good long term. And so the question then becomes like, which one is right for you? Well, I don't know, you as the listener listening to this, which one's right. I can only tell you what I do, like what we've done, my wife and I have done for our family, and that's term insurance. We each have multiple policies too, by the way. So as our incomes and our responsibilities, like having kids, have grown, we've added coverage to fit our timeline. So you have to take into account things like financial resources that you have. If you're saving and you're doing the right things along the way towards your journey to retirement, your need for life insurance should theoretically decrease over time because your assets are growing, and also your life situation is changing and evolving. Your kids, aka your dependents, grow up. You maybe have less of a mortgage or no mortgage at all as you get older, and so you have this savings and retirement bucket built up. So I've heard the arguments, that with with whole life, you build this cash value and you can use it as part of your savings and your investment strategy. That's not necessarily a philosophy I subscribe to. It's not because it's not true. It absolutely is, but it comes at a cost. I'm a huge believer in optimizing every dollar saved, especially if you're on a budget and those dollars are of a limited resource. So you only have so many dollars to spread around for savings and for protecting yourself financially. So if it's for retirement, for example, I'd rather not use the cash value of my whole life policy. I'd rather use things like 401ks or Roth IRAs. If it's for college, I'd rather not borrow from the cash value of my life insurance. I'd rather use 529 plans. Whole life could definitely be part of your story if you're looking for life insurance throughout retirement as well. And it can be an effective tool if your budget is not as limited, as there are some tax advantages that come to growing with cash value in a whole life policy, especially if you're in one of the highest tax brackets. You're going to care more about this. So, how much is the next question I get? There's a couple of different ways to arrive at this answer without taking you through like a full blown financial plan and analysis to determine how much. My favorite rule of thumb is 10x your annual salary. So, this is known as income replacement. Like this common rule of thumb, for most of the time, like even if you Google this, you'll see like 7 to 10x your annual income. I err to the side of higher, so I say 10. But this ensures that your family can maintain the standard of living and then cover everyday expenses in your absence. There's other ways to look at this if you wanted, let's say, less coverage, or maybe if you're retired and you don't have earned income anymore to replace. But maybe in the bare minimum, you'd like to cover debts and liabilities. So you just calculate your outstanding debts, maybe your mortgage and car loans, and that might be enough to suffice. Or something else to consider is final living expense. Final expenses is what they call it. So that includes things like death, burial, funeral expenses, which can range anywhere from $10,000 to $20,000. So income replacement or debt and final expenses coverage is one way to look at it. I like the rule of thumb of 10x your salary. There's another one called the DIME strategy. Have you ever heard of this? This is kind of interesting, but it's a way to calculate it. So DIME stands for debt, income, mortgage, and education. So and on the income side, so it's kind of like what it sounds like. With debt, you're calculating your total debts that you have excluding your mortgage. With your income, you're taking your annual income number, multiplying it by the years in which you would need that family support. So let's say like leading up to whenever you retire, you take the total outstanding amount of your mortgage and then the estimated cost of your children's education. So quick example, if your annual income is $50,000 times, let's say 10 years is your target retirement, that's 500 grand. If you have outstanding debts of 10K, an outstanding mortgage of 200K, education of 100K, you're looking at somewhere around $800,000 in a calculation for coverage that you would need. I did that math pretty quick off the top of my head. I really, really hope for the sake of this podcast, since I do math for a living, that I did that right. Okay. So now that life insurance is out of the way, I'm going to switch gears to health insurance. So I my hope is I don't have to spend a lot of time here on this topic. I think we all know we need it. The likelihood of needing medical care in any given year for an adult is at 85%. The probability of an individual's death in any given year is 0.87% based on actuarial tables. So the risk of catastrophic financial failure is real, and substantially a greater percentage of risk if you don't have proper health insurance in place. So back to my opening statements, I've seen a family file bankruptcy before because they just didn't have proper health insurance in place, and the cost of those medical bills were just too great for them to bear. There are a number of ways to get proper health insurance. You could go through healthcare.gov. You might even be able to do the Affordable Care Act thing where you get a tax subsidy as a result of it based on your income. This is a really detailed and intricate area of planning that we help clients on, by the way, but most people are surprised to find that they're eligible for a tax credit going through healthcare.gov. You could get an employer-based plan, which a lot of our clients have, a Christian share plan that's grown in popularity over the last decade, or Medicare if you're over 65, or Medicaid, depending on your income situation. So my big thing that I'd like to implore you with is just know what you're getting, know what your out-of-pocket max is, know what your deductible is, and audit this every single year. Hey there, you're awesome for tuning into the show. Do you want bite-sized daily doses of above-board content delivered straight to your Amazon Alexa? Subscribe to Canterpath 365 and enjoy our daily brief featuring market updates, relevant financial news, and mini clips from yours truly on this podcast, as well as Rich and Matt. Visit Canterpath365.com to sign up. For my family, we have a high deductible health plan, and that means we're eligible to fund this thing called an HSA, a health savings account. By the way, pro tip, you can only fund an HSA if you have a high deductible health plan. But as a family, we can fund $8,300 per year, and that is getting a triple tax savings. We're putting $8,300 in, getting a tax deduction from the IRS for putting it in the HSA. It grows tax-free, and it can be it can be taken out tax-free if used for qualifying medical expenses. And then maybe we could do a whole podcast on that someday. So again, the importance of healthcare is there. Make sure you have healthcare insurance. I'm going to move on to the next one that we talk about often with our clients, disability insurance. A very boring one, but one that has a ton of different factors involved into it. Cost is going to be probably the biggest thing that makes this prohibitive or something that you need to consider when getting this. So most of the time, if you're working at a company, a lot of times it's an employer provided benefit. And if not, you need to secure this on your own, and it could be very costly. The downside is, just like with health insurance, you're significantly more likely to have a disability claim in your life than a death life insurance claim in your life. There's about a 25% chance that a 20-year-old today will experience disability lasting longer than 90 days before they turn the age of 67. 67 is used because that's when the IRS defines as, or Social Security defines that as full retirement age. So disability insurance is kind of what it sounds like. Provides income replacement if you're not able to work due to an illness or an injury. There's a number of things to consider. So number one, there's short-term disability. That's typically like a few months up to a year in coverage. That would be like for temporary things like a short-term illness, something minor that had like a minor injury. That could also include maternity leave. And then there's long-term disability, which that's the one I'm really focused on here. So this can provide a benefit for several years. So it could be like a defined period of years, or it can go up to 65 or even up to, for the rest of your life. There are what they call exclusionary or waiting periods. So typically it's like a period of time that you have to wait before the benefit kicks in. 90 days is a pretty common waiting period. And then, the common use here is going to be for chronic illnesses or a significant injury or long-term disability. Really great example that I'd like to share is a client and a good friend of mine who is a dentist. It was an absolute necessity for him to maintain disability coverage because of any number of issues that can cause him not to perform his job. I mean, think about it, like as a dentist, like you're doing this intricate work that could be vision loss, that could be losing a finger, breaking a hand, that could be a neck injury or a back injury that prohibits you from being able to lean forward and sit in these chairs all day and work on your patients. All of these things could have created a loss of income for him. So it was very imperative to have this. Now, typically you'll see the benefit be communicated like 50 to 70% of your gross income. So if you make 100K, your disability benefit might be anywhere from 50 to 70,000. It's not a full income replacement. It's a partial income replacement. That's how these long-term disability companies view it. So when you're choosing they call it a DI policy, a disability insurance policy, there's so many variables that you have to consider. There's policy definitions like own occupation. versus any occupation, or there's the coverage length, there's the elimination period, there's exclusions, limitations, and riders. There's just a number of things to consider. So you're going to want to work with a professional who specifically does disability insurance to help guide you through this conversation. But it is a really crucial safety net to ensure that you're maintaining financial stability if you're unable to work. As with all things, we have to balance the budget and the cost of insurance, and then just kind of strike the right balance between affordability and coverage options. So, as I'm moving through and I'm trying to keep this conversation short and abridged, so like I promised you, I'm trying to unboring the most boring topic in personal finances. I'm going to move to the next one, which is umbrella insurance. So many people have maybe started, at least in the last few years, I'm finding people have heard about this, but it's not something that they're thinking about or that they have for themselves. And it's a big gap in coverage. And frankly, it's really cost effective to deploy this to protect you. So the idea here is it's designed to provide additional coverage beyond the limits of your standard insurance policies, like your homeowners, your auto policy, maybe your boat insurance if you have a boat. It offers like this added layer of protection in the event that you're held responsible for like a significant claim or even a lawsuit. So the goal is to avoid someone like getting in a slip and fall at your house or getting into a car accident and then they sue you above your policy limits. You want, the goal is to have something that's going to protect your personal assets so they can't come after those things. So your umbrella insurance typically kicks in only after those liability limits of, let's say, your home or your auto policy have been exhausted. So, for example, if you have an auto insurance policy with a $500,000 liability limit and you're sued for $1 million due to this accident, your auto coverage will cover the first 500K, and your umbrella policy, in theory, should cover the next 500K, assuming you have at least 500K in coverage on your umbrella policy. So they start with high limits, though. I mean, you typically see them range from like $1 million up to $10 million and more, depending on like the insurer. Like I said, they're very cost effective. And one of the things that I guess the question that's probably coming up for you as you're listening to me talk about this is like, great, John, that sounds good. Like, how do I arrive at how much I should have? Very simple rule of thumb: match your net worth, whatever your net worth is. So if your total net worth, which is your assets, both liquid and illiquid, so including your home, minus your liabilities, is 2 million, then consider having $2 million in umbrella coverage. The good news is, as I mentioned, very cost effective. Last time I checked, I believe the company that my wife and I use, it was somewhere around like $400 to $450 per year per million in coverage. So that was a mouthful, you guys, and I tried to go fast, but I want to end with a couple of different things. One of them is, what insurances don't we have? I get this a lot. John, should I have mortgage insurance? Should I have travel insurance? And those, for me, those answers are, it's unique to you. And if you feel like if it can help you sleep at night, I'm not going to tell you no, not to have something like this. But mortgage life insurance, instead of having like a mortgage insurance policy, which they sell you pretty hard when you buy a house and you have an outstanding mortgage, you'll get tons of offers in the mail saying like, for this amount a month, we'll cover your mortgage if something happens to you. A regular term life insurance policy is going to be more flexible. It's going to provide better coverage, and honestly, it's probably going to be more cost effective. So we don't typically recommend those. My wife and I don't usually ever do travel and flight insurance. Occasionally, I'll pay extra through the provider, not through like a third party insurance company, but I'll pay extra through, like, if it's JetBlue or Delta or whatever, we'll pay extra to like have trip cancellation flexibility in case it's like something that's happening and we need to, life is happening and we need to be able to cancel those flights. But in my experience with travel and flight insurance, we've paid for it several times and we've had to use it at least twice, and it didn't really work out in our favor to even have that. So it's like, why are we going to pay this premium if it doesn't work? Now, we could probably have like a travel agent on here that might dispute that and feel differently. But again, this podcast is about what I do have and what I don't have, and those are not insurances we typically carry. And then we never do extended warranties on things either. It's usually pushed for electronics or appliances. They're overpriced and they offer very limited benefits compared to like a manufacturer's warranty or just like the consumer protection laws that we have innately. So one final thing I want to end with: what insurance will I definitely have in my future that I don't have now? long-term care insurance. So I wrote a blog on this earlier this month, but it's typically for older individuals that need coverage for skilled nursing facilities. They need help with daily living activities as they age into retirement. So commonly, we'll see families secure this insurance, if they're going to at all, somewhere in the early to maybe mid 50s. The design here is to help you offset the risk of depleting your portfolio assets and depleting your net worth into your elder years, to protect those assets for the sake of your longevity, because we don't know how long you're going to live. I mean, the way that technology and advancements in medicine is happening today, it's much, much longer, or for future generations. So long-term care insurance is very important. You could go to canterpath.com/blog, see my latest blog as I explain that a little bit more. But that's it today. Oof, I am exhausted. So where are we at right now? I'm at 20 minutes in, and I fire hose you with insurance information. Hopefully did my best to keep this somewhat interesting. I'll admit I was a bit intimidated about doing this as a podcast because A, it's boring, and B, it's there's just a lot of details when it comes to all these plans. So to try to go high level and explain the uses and where we use it as a family is sometimes difficult, but that doesn't mean it's not useful. And my hope today is that that conversation was helpful for you. And if it was, please share this message with someone. As I said in the beginning, we're not out to solicit insurance business, but there are major pitfalls, major deficiencies in people's planning, as they often overlook some of these things. And we wanted to make sure that we're putting good information out there to help ensure that you do not overlook these things. So until next week, I am John Kennedy, one of your certified financial planners and co-host to the Above Board podcast. I'm signing off. Thanks for hanging with me today. We'll see you next week. Bye.